Welcome back. I hope you have had a wonderful week. This week we're going to talk about some tax myths, specifically around the sale of your home. So the first myth that I hear quite a lot is, if I purchased a new house, I don't have to pay tax on the one that I sold. I bought a new house right away. That was the rule once upon a time. In 1997, it changed. At this point, buying a new house within a set time period does not impact the tax treatment of the one that you sold. You still have to report the one that you sold. The only time that purchasing a new property defers the profit on the one that you sold is if the one that you sold was a rental property. So that's a whole different ball of wax. The other myth I hear a lot is, I received this many dollars at closing, so that's what I should pay tax on. Maybe by the time the loans were paid off and everything, you received $200,000. The IRS doesn't care. So let's take a look at how they actually do calculate the profit on this transaction. So let's talk about a home that sold for $1 million, just because I like round numbers. Your closing costs, commissions, state excise tax, a lot of the fees, a lot of those things are deductible. Let's just say, for the sake of argument, that that's $75,000 on this sale. Maybe you also paid to fix up the place before you sold it. You had a stager come in or put a new paint job, something. That counts. You can add that as well to your cost in the property. So as far as the IRS is concerned, on this sale, you received $920,000. And again, they don't care that maybe of that $920,000, several $100,000 went to pay off your loan. So you're not going to pay tax on the $920,000 though. We're going to then look at, what did you pay for the property? In this case, we're just going to say $300,000. How much did you put into the property over the years? Did you remodel the kitchen? Those permanent things that you did to improve the property add to your cost in the house. So now we're up to a cost of $380,000. We had already calculated a proceeds of $920,000. So now we've got profit of $540,000. That's what you would pay tax on. But will you? Let's talk about the principal residence exclusion. So remember when I said that the laws changed back in 1997? This is how they changed. So if you owned and lived in the house, it was your primary residence, it's where you're registered to vote, it's where you live the majority of the time, for 2 of the last 5 years, then you don't have to pay tax on $250,000 of that profit, or if you're married, $500,000. So in that example where we had $540,000 worth of profit, if it was a married couple, we've got $40,000 left of profit that's actually going to go on the tax return and be taxed. So we started at $1 million, we're down to $40,000 of it being taxable. We're doing pretty well. There are some complications if you have ever taken depreciation on the property. So if you'd had a home office in that property, you may pay tax on the amount of depreciation taken. If the property had been a rental, this gets much more complex, and I strongly encourage you to talk to your tax pro to really do the math on that and to help make sure that it makes sense for you to treat it this way. So how much is the tax? We're down to that $40,000 tax. What happens to that? Or $40,000 in profit, I should say. So that $40,000 in profit is going to be added to your other income on your tax return that gets filed the next tax season. So with that $40,000, again, assuming we're talking about real estate that's been held over a year, it would have had to have been to take that primary residence exclusion. The maximum amount of tax you're going to pay on that $40,000 is 23.8% plus any state tax. In Washington, we don't have to worry about that. But that adding that additional profit to your tax return may also cause your income to be too high for some credits and such that you may normally receive. So your tax on your ordinary income, your wages and all of that could go up a bit with this profit, especially if it's substantial. At the same time, if you have some investments and they haven't been doing very well, and you sell some stock at a loss, those investment losses are going to bring down that profit on the house. So it's definitely a strategy that if you've got a substantial profit on the sale of a residence, you may want to look at your portfolio and see if there's something that you can sell to help bring that profit down. All different strategies to consider. Definitely talk to your tax pro. Did I miss any myths? Any remaining questions? Did I make anything more confusing instead of less? What should we talk about next week? Subscribe and let me know. And I will see you next week. Have a great week. Bye.